Hi, I'm Jeff Lovell, a staff accountant with AA Accounting, and today I want to discuss how to avoid the accumulated earnings tax on C corporations. During an audit, the IRS can impose a tax on C corporations that have a retained earnings balance of $250,000 or more, or over $150,000 for a personal service corporation, which I'll discuss later. This tax only applies to C corporations, not to S corporations, and the tax is equal to 20% of the excess accumulated earnings. Suppose Bob's Bakery Inc. is a C corporation. On its 2015 tax return, the company reports retained earnings of $750,000. The IRS audits the return and determines that the company only needs $350,000 of this to fund operations. The IRS would impose an accumulated earnings tax of $80,000 on the company. This is 20% of the excess earnings of $400,000. This is why we call it a use it or lose it tax. Personal service corporations are only allowed to accumulate $150,000. They're defined as companies whose earnings primarily come from providing personal services in the industries on the screen, and whose stock is primarily owned by shareholder employees who provide the services. A corporation's accumulated earnings, also known as retained earnings, are made up of the profits and losses shown on its tax returns since it was formed. The company can either keep or retain these earnings for some future use, or it can pay the earnings out to the shareholders. Such payments are called dividends and are generally taxable to shareholders, which is why many corporations avoid paying dividends. If the company doesn't pay out dividends, it must be able to show a reasonable business need for the accumulated earnings if it wants to avoid the 20% tax. The IRS is fairly generous about what it considers reasonable business needs, and will allow the company to retain earnings above the threshold for an expansion, such as buying another business or opening another location, paying off business debts, redeeming stock from the estate of a deceased shareholder, investment needs, loans to customers or suppliers, working capital such as cash, inventory, or accounts receivable, and providing for contingencies such as lawsuits that don't go your way or insurance. The IRS considers any of the following to be unreasonable business needs: avoiding paying dividends, paying the shareholders' personal expenses, or providing loans to shareholders or related corporations, providing loans that have no business purpose, or saving for investments that are unrelated to the business's activities. If you have questions about this or other tax or accounting questions, give the experts at AA Accounting a call. We have over 60 years of tax, payroll, and accounting experience. Call us today to schedule an appointment to discuss your situation. We look forward to hearing from you.